What is going on, everyone? Anthony Drew Gary here, host of the How To Show, where we talk about optimizing life, money, and happiness one how to at a time. This week on the show, we're talking about residential real estate, primarily single family homes, and the fears that are currently in the marketplace as it results. Because recently, the Fed has increased interest rates rather dramatically over the last handful of months, and so the real estate market looks a lot different right now at the end of 2022 than it did at the beginning or even a couple of months in. And this has a lot of people fearful. There's this idea that for whatever reason, 2007, 2008, 2009 memories or stories or hauntings of what happened. We're almost out of Halloween season now, but people are afraid of what's going on in the real estate market right now because they think a crash is coming. And I'm not here to tell you that you're right. I am here to talk about why I do not think there's going to be a crash in the real estate market. And so again, this is another why instead of a how-to, but we're talking about real estate today. We're going to talk about why I do not believe the real estate market is coming to any sort of crash, though there may be some corrections. And so I want to talk about this with some anecdotes and with some actual factual information to break down where we're at and where I think things are going. But to do that, I need some graphics. So switching over now. The first thing we're going to talk about is mortgage interest rates. As you know, the Federal Reserve has increased the Fed funds rate lately. And if you don't know that, you do now. So what that really means is that the baseline amount that it costs to borrow money is more expensive than it was earlier in this year. And I think that that's a fair statement to make at any point in recent history, because at the beginning of the year, it was as low as it basically could be. You were borrowing money almost for free. And so when you mark that up a little bit for the lending institutions to package dollars to be borrowed through mortgages, the interest rates for 30-year mortgages were historically low. They were basically 3%, and for a little bit of time, they were less than that. And so I've got a side-by-side set up right now with two different scenarios, both of which are borrowing $400,000, one of which is at the old interest rates at around 3.5%, and one of them is at the new interest rates now, which is about 7.5%. So if you're borrowing 400 grand to potentially buy that $450,000 or $500,000 house at a 30-year fixed rate, both sides are the same there. Just your principal and interest payments have gone up $1,000 over the calendar year. And realistically, that is possibly the difference between being able to afford the house and being able to not afford the house. And so what this means is that, at this $400,000 and above price point, first-time home buyers could potentially get priced out of certain markets. And so I want to stop for a second and basically lump houses into a couple of different categories because I think that's helpful. And the numbers that I'm going to use are basically associated with the Midwest. I live in Indianapolis, and so I'm talking to my market specifically, but go ahead and follow along with me if you're on the outsiders, if you're on the coast. You can pretty much multiply my numbers by 2 and it still factors some level of truth somewhere along the way. And so realistically, we're looking at houses that are less than 250 grand. We're looking at houses between 250 and 500. We're looking for houses at 500 to 750, and then you got 750 or above. And so I break the real estate residential market down into these 4 categories to prove a point over time and over different images that we're going to talk about today, that the impacts of the interest rates on the real estate market are unlikely to hit every price point the same way. There are going to be differences felt if you're at different price points. And I think that this is a great example here. The difference between a payment of $1,796 and a payment of $2,797, realistically for most families, probably is the difference between being able to afford and not being able to afford the house. So what does that mean? It means practically if you were looking at a $500,000 house, or if you live in a $500,000 house and you were looking to sell a $500,000 house, the number of folks who could potentially buy that house from you has significantly decreased over the last 5-6 months. So let's get into a little bit more of the sociology and the demographics behind what's going on. But the next slide is a little granular because this is a screen capture of a poll that I took on LinkedIn not that long ago, and it's a relatively small sample size, but the thought here is indicative of some trends that we might be seeing. And so I asked the question, does the thought of trading a 3% mortgage for a 6% mortgage give you pause in thinking about a housing change? And so my graphic here, I did this poll a handful of weeks ago, and it's already out of date because getting that 6% mortgage really isn't happening anymore unless you're in an extraordinarily good position with your credit score or something like that. That number is a lot closer to 7 now. And so I ask this question because this is a scenario that current homeowners who have debt on their house likely find themselves in. And so if you have a house right now and you're living in it and you're thinking, I either want to move up or down in house, or maybe I want to move into a different school district, or maybe I want to make a move to a different geography because I've got a job and I work from home now and I can be location independent. Realistically, if you're locked into a fixed rate mortgage at 3% right now, and you want to go try to buy a different house, the amount of house that you could buy without having to come out of pocket more is significantly less than it was. It really goes back to the same graphic that I had just a minute ago. And so if we go back to the first graphic, thinking about it from this lens point, if I had a payment that was $1,796, that was a $500,000 house that I bought some months ago. And so in order to buy that same sort of priced house somewhere else, to make that move, I would have to pay significantly more now for it. And so I can see that being a scenario where a lot of current homeowners, because they bought their house in a really low interest rate environment, potentially have golden handcuffs locked to their house because they don't necessarily want to sell, because they would have to go find a place to live somewhere else. And the cost of capital is a lot more now. It would ultimately make them pay more. So what's that practically mean? It means that I suspect that inventory or houses that are on the market will continue to stay low because people are going to be more conscientious about making housing changes. Whereas in a different interest rate environment where you could essentially a couple of years ago trade your mortgage for another mortgage at roughly the same rate, you would be more inclined to not consider mortgage rate as part of the equation. So let's go ahead and continue here. We'll get into some more demographics, and we're going to go back to high school economics, or maybe you saw this again in college economics. Real estate in general is set up on supply and demand. And so this is the basic supply and demand curve. I'm not going to belabor the points, but you've got a couple of factors at play here. You've got the quantity supplied, the quantity demanded, the price, and the overall quantity available. So each one of these factors on its own still applies to the real estate market. The real estate market is an economic market, just like any other marketplace, but there are some additional items that are beyond folks' control. And a great example of this would be the price lever in a scenario like this, where even though the price is set at a mark that would have your payment at, we'll go back to slide 1 for a minute, the price is set up at $27.97. But your ability to pay may only be that $17.96. And so even though that you have a willingness to pay, it does not necessarily mean that you have the means to pay it. And so it can get a little complicated there. And so just want to make a reminder that, the real estate market is a supply and demand driven market, but it's also driven by some other factors that we're going to continue to talk about. So the next slide here is the United States population. And while I'm not going to go into the details of what this chart says, up and to the right, generally speaking, the United States population is growing. And so realistically, that means that there need to be more housing units available for people to buy. While at the same time, the average number of people per household in the United States from the 60s to now has decreased by almost a person. It started out at 3.33 people per dwelling unit, and now it's at about 2.5 people per dwelling unit. I can think of a couple of different reasons for this. Number one is you might make the case that people are having fewer children, though overall population statistics may not agree with that. You could also look at that because the people are living longer. That allows more people to be on the earth at any one time. That may be a reason why population's growing, even though fewer children may be being born. The other thing that I want to look at from this graph specifically is that, quite honestly, the divorce rate in America is higher than it was in previous generations. And so for the same number of people, you have more households. More households mean more housing units needed. And that's not only apartments, that's single family houses as well, because all of it plays in. And so we'll continue on this thought process. And here's where we come into a little bit of an issue. We already established in the last couple of slides that we need more housing units. And this slide, and I'll specifically zoom in on this one, during the 2010 to 2019 decade, there were a substantial drop off in the number of houses that were built in the United States. And quite honestly, this comes as a result of happening right after the previous housing crash. There were a lot of home builders that were afraid to commit to building new projects, not necessarily sure that the value was going to be there. And so the statistics are a little still shanty for the 2020 decade, but overall, there are fewer houses being built than at any time since basically World War II. And so you have basically a perfect storm here where you have more people needing houses, you have fewer houses available, you have fewer people living in those houses. Oh, and by the way, we'll switch into one more graphic here, which is from Freddie Mac, that talks about the shortage of construction builds, specifically in starter homes. And so I will zoom back out on this one. But what it basically says in this article was that between the 1980s, 40% of the homes constructed were entry-level homes. And that's basically defined as 1,400 square feet or lower. And now in 2019, only 7% of the homes constructed were entry-level homes. And there are a lot of factors at play here, but mostly the cost of construction, the cost of land, the cost of infrastructure has gone up such that larger homeowners, in order to make profits, need to build bigger houses that cost more money so that there can be some profit involved in them. And so we have a situation here where there is a disconnect between what's being demanded and what's being supplied. We have a scenario where the average new house in the Indianapolis market, you've got to come out of pocket roughly that 400 grand that we first talked about in the slide one to be able to get yourself into that house. And realistically, the first-time homebuyer population cannot afford those new builds. So we have a supply and demand curve problem here, because what is being demanded, which is essentially affordable housing at its core, and that can be defined in a number of ways, but affordable housing is being demanded and affordable housing is not what's being supplied. And so again, I think this is going to hit different parts of the real estate market differently. You know, realistically, if you have a house that's worth 250 grand or less, I don't think you have anything to worry about, because that is the pay to play entry level to be able to buy a house in my specific area and in other areas of the country as well. And so I suspect that demand will continue to be there in that segment. But when you start getting to that $250,000 to $500,000 range, you know, all of a sudden people who could afford a $500,000 house 6 months ago find themselves in a situation where now maybe they can only afford $350,000 or whatever that looks like. And so I can see a scenario where incrementally, as you get more expensive in house, there are going to be fewer people available who can afford that house. And so I just want to draw out a situation here that, you know, prices in 2007, 8, 9, they pretty much unilaterally went down because everyone was impacted. But I can see a scenario here where folks who have more expensive houses are largely impacted harder or more so than folks who have a lower price point house. You know, realistically, as a real estate agent, I have different searches set up for myself just so that I can keep tabs on the marketplace. And I don't see any price decreases for the houses that are selling at 175 to 225 grand. I am seeing price decreases for the houses that were listed at 500 that are now at 470. And oh, by the way, they were at 480 in between there, and they still weren't getting the traction needed. So wanted to make this video to talk about different segments of the real estate market and why things are happening, and ultimately why I do not believe there's going to be a crash, because I don't think everybody is going to be impacted at the same level. Realistically, there could be some, if you've got a house to sell and you've, you know, you're in that $750,000 price point, It could take a little bit longer to sell that house simply because the ability to pay for a house like that has changed over the last 6 months. So wanted to make this video, one, because I love talking about real estate, two, because I think it's hopefully informative for you, and three, to generate some dialogue. If you did not understand anything that I'm talking about in this video, leave me a comment down below. I will answer you. Let's switch back over. That's going to bring this episode of the show to a close. Hopefully there's some tidbits in there that you can find valuable. And if you know somebody that is either in the market to buy or sell a house anytime soon, two things. Number one, make sure that they're watching this video, share it with them. Number two, if they are in the Indianapolis market, I can help them with that. Make sure you know what's going on. You can get in touch with me in the comments down below or at indiedwell.com. And as always, you can be the first to know about new content each and every Wednesday by hitting the subscribe button. Hit the notification bell as well. I am at an all-time high for subscribers. It's a lot of fun, but that's not why I do this. I do this because it's fun. I do this to get better at speaking, and I do this hopefully that it can help somebody along the way. As always, you can leave me feedback down below. Let me know how I'm doing. Let me know what I forgot. Let me know what I should have added. Let me know what you want to hear about, or if you just want to say hi, you can do that too. Down in the comments below. That's a fun way. I will engage with each and every one of you if you do that. Until next time, this is Anthony Drew Gary, host of The How To Show, signing off.